We now turn to Module 6.3, where we'll focus on the valuation of interest rate swaps. And this will conclude our trek through valuation issues. When we move to Chapter 7, we'll turn to static risk measures. The central finance concepts that we'll be covering here, we're going to introduce interest rate swaps, introduce you to the terminology of notional amounts and gross market value. We'll illustrate how swaps are used to create synthetic debt instruments and look at interest rate swap based interest rate swap model assumptions. Some of the language, there are two counterparties. There's not a buyer and a seller. There's a receive fixed and a receive floating. There are two legs to your typical vanilla swap. There's a floating interest rate and a fixed interest rate. Typically, interest rate swaps are what are referred to as advanced settled in arrears. That is just like a bank CD. The interest rate is identified at the beginning of the period and paid at the end. Plain vanilla or just vanilla swaps using the old LIBOR-based method were actual 360 quarterly on the floating leg and 3360 semi-annual on the fixed. And pricing, if I'm pricing a swap, that implies I'm setting the fixed rate. If I'm valuing a swap, that implies that I'm coming up with the current dollar value. Typically, when a swap is entered, the fair value of the swap is set at 0. And so pricing means I'm setting the fixed rate. Valuation means I'm identifying the current dollar value. The notional amount of swaps, the first thing to notice about this graph is that the y-axis is measured in trillions with a T. And so the notional amount is measured in hundreds of trillions of dollars. And that's a huge number. And that's the basic takeaway is interest rate swaps have been wildly successful. There are extremely useful instruments in the management of interest rate risk. Interest rates lie at the very heart of all of finance. And this is a useful instrument to manage the corresponding risk. The currency swaps are just very tiny when measured against interest rate swaps, but they do exist. A currency swap is typically just an agreement to exchange the fixed or floating stream of cash flows in one currency for a fixed or floating stream of cash flows in another currency. And so the gross market value, interestingly, is much smaller, but it's still measured in trillions of dollars. And so if you think about an interest rate swap as a financial derivative, the fair market value of all of them should be 0. But in this case, we're looking at the fair market value of the receive fixed leg or the receive floating leg. In other words, the aggregate value of receive fixed pay floating or receive floating pay fixed in absolute terms. And so this is the gross market value of the one side from one side's perspective. The underlying deliverable, at least in the old interest rate swap market, was LIBOR. And if you'll notice, LIBOR tend to track just a little bit above 3-month Treasury. There were times when there were major disruptions. There were times when the LIBOR rate was allegedly fraudulent in nature. The setting was fraudulent. And that the fact that this is smooth, I've been told, is one of the identifying characteristics that something was amiss. But in the future, it'll probably be the secured overnight financing rate, and that too will track closely with U.S. Treasury, short-dated U.S. Treasury instruments most likely. Well, how are swaps used? If you think of some company, REB Incorporated issues a fixed-rate bond because that's what my bond investors want. However, as the company, what I really want is a floating rate exposure because my assets are floating. So I want my liabilities to be floating, say. And so what I will do as a REB is I will issue my fixed rate to bond investors because that's what they want. And I'll enter into a receive fixed pay floating with a swap counterparty. Typically, these swap counterparties are large banks. And if you'll notice, that fixed rate just cancels out with what I have to pay the bond investor. So I have what's referred to as a synthetic variable rate bond. Do I actually have a variable rate bond? No. On my financial statement, I have a fixed rate bond, and then I also have a interest rate swap. Valuation model assumptions. We'll assume there's no market frictions like taxes or transaction costs. I'll assume I can borrow and lend at the risk-free rate is available. All I require is that investors prefer more or less. I assume an active forward rate agreement market is available. This is a technicality in order to get the arbitrage to actually work. The quantitative finance material, this particular module is quite quantitative. And so there are two ways to price an interest rate swap. One is as a pair of bonds, and the other is as a portfolio of forward rate agreements. And then when you value a swap, you can value it using a single spot curve or a forward curve and a spot curve. So some of the technical details, I have a notional amount that's applied to cash flow J. Some swaps are in fact amortizing, and so the accrual period for the fixed leg may not be the same as the accrual period for the floating leg, and so there's an accounting for that. And NAD is the number of accrued days, NTD is the number of total days in the year. So if there are 91 days in a quarter and the number of total days is 365, the ratio would be 91 over 365. The floating rate, if you'll notice, the subscript J minus 1 is the prior period because it's advanced settled in arrears. So the fixed rate leg, the cash flow, what you do is you take the notional amount, you multiply it times the accrual period. If it's quarterly reset, that accrual period will be approximately a quarter of a year or 1/4, and this will be an annualized interest rate. The floating leg is similar, but again, notice at the fixed rate, there's no subscript J or I, and that's because it's fixed. It doesn't change over the life of the swap. The floating leg does in fact change, and it's reset every payment period, and so it's J minus 1. So to calculate net cash flows, the receive fixed counterparty, it would be the cash flow on a given settlement date would be the cash flow that I receive from the fixed leg minus the cash flow that I pay from the floating leg. And again, I just take that subtraction. If it's receive floating, if you'll notice, it's just a minus sign, or you reverse the payments. So for example, if I have a 1 million notional amount, 90 over 360 accrual period, fixed rate is 2%, floating rate is 1.75%, my net cash flow would be 625. Interest rate swaps are netted. One party doesn't pay the fixed and the other party pays the floating. They settle up on the net. For example, if this is a receive floating pay fixed swap, I enter into let's say this is a 4-year annual reset interest rate swap. And so if it's receive floating pay fixed, if you'll notice that this cash flow is tied to the floating rate over period 1. This is the cash flow over period 2, period 3, and period 4. And so if on this particular swap, my hope is that the floating rates go up. Everything else the same. Well, how can I value this particular stream of cash flows? I could value them as a pair of bonds. You could think of this as long a variable rate bond and short a fixed rate bond. And if you'll notice, the par values cancel out, and I have exactly the same cash flows as the interest rate swap. So when I first started in this business in the late 1980s and early 1990s, the primary way people priced and valued interest rate swaps was as a pair of bonds. By way of a cash flow table, this gets a little bit technical, but if I enter into a receive fixed swap and then buy a variable rate bond short a fixed rate bond in the right amounts, I end up with zero cash flow for sure. So the next net cash flow, that question mark ought to be 0. If it's positive, I'll do this set of cash flows. If it's negative, I'll do receive floating and short a variable and buy a fixed and turn that negative cash flow into a positive. Well, with this particular setup, I can solve for the equilibrium swap rate and hence price the swap. If you'll notice the math, you can check the details out later, but the math works out to be 1 minus the value of the payment per dollar of the last cash flow on the fixed divided by an annuity of the payments of the fixed. And so one way to view this, if this is the spot rate data given, these are the forward rates. It's basically 1 minus the last discount factor divided by the sum. So pricing a fixed rate swap is very simple. It's just 1 minus that last discount factor divided by the sum of the discount factors. In this case, this is 1.2968%. An alternative way to do this valuation is as an exchange two cash flows at a point in time in the future. This describes a received fixed FRA. Receives one payment based on the fixed rate established at time 0, makes one payment based on the floating rate established one period before the payment is made. And so each cash flow in an interest rate swap is hedged with an at-market FRA. The resulting known cash flows is financed today. The net present value of these cash flows should be 0. Again, this gets rather technical, but basically a received fixed swap can be viewed as a portfolio of forward rate agreements. These are off-market forward rate agreements. This results in a positive or negative stream of cash flows out here that have to be financed. And so the net cash flow should be 0 because the future cash flows are 0. And so this swap should be related to the present value of those specific cash flows. The valuation details, again, if you're coding this up, you want to maximize your flexibility. And so I want to use a discount rate that can vary across the term structure. I need a notional principal that can reflect amortization if that exists. And then the number of accrued days and number of total days could vary. And the forward rate is, advance set settled in arrears. If you'll notice, the number of floating payments might not equal the number of fixed payments. For example, if the fixed payments are, if a 5-year swap is reset semi-annually on the fixed leg, then that is 10 future cash flows. If the floating leg is quarterly, then that's 20. And so the interest rate swap valuation summary is simply the value of the swap is equal to a simple summation of an adjustment on forward rates and an annuity times the fixed rate. It turns out the equilibrium swap rate can also be viewed as a portfolio of forward rate agreements where the weighting scheme is based on the notation given before. Interestingly, the sum of these weights might not equal to 1, but again, the fixed rate is simply a weighted average of the forward rates, making it a very intuitive way to understand where the equilibrium fixed rate ought to be. And there's some numerical examples given. I would encourage you to, if you're trying to understand the nuances of these markets, that you work through this. Make sure you understand that there are 2 ways to arrive at the same rate. I could take 1 minus the last discount factor divided by the sum, or I could take a weighted average of the forward rates and I get the same exact number. And so there are 2 methods to arrive at the exact same result.